Hi guys, welcome back. Today I will delve into a confusing issue. How do firm value and enterprise value differ from one another? Undergraduate academicians and finance professionals may misunderstand each other because of this issue. So let's make things clear. While sometimes used interchangeably, it's not entirely true to say that firm value and enterprise value are the same. While firm value is taught in academia, this is part of the curriculum of most bachelor courses in finance and accounting. Enterprise value is favored in practice. Business decision makers use this in measuring a company's worth. To demonstrate this, visually, let us refer to the following balance sheet that is based on true value. On the left side of the balance sheet, we have the uses of the funds, the assets. I'm going to put here cash, the non-cash current operating assets like receivables and inventory. Then you have the long-term operating assets, the property, plant, and equipment, as well as intangible assets that are used in the primary business of the company. On the right side of the balance sheet, you would find the sources of the funding, the liability and equity items. We have current operating liabilities, such as your trade payables. Then we have debt, as well as shareholders' equity. Let me make some adjustments there. I'm going to offset current operating liabilities from the non-cash current operating assets. And that would leave you with non-cash current assets less current liabilities. We call this collectively non-cash working capital. So there you go. The balance sheet is still balanced after that offset. The first thing that I would like to talk about is the equity value. We all know what the equity value is. Equity value is the value attributable to the owners of the company. I'm talking about the common stockholders. Equity value can be arrived at by multiplying the stock price by the number of common stocks outstanding. This is also known as the market capitalization. Or alternatively, we can take the market value of the assets and deduct the market value of the liabilities, and that would give you the equity value. Now, what about firm value? Firm value is the value generated by the assets of the company, net of current operating liabilities, as what we did a while ago. So, another way of putting it, it is the value that's attributable to both the debt holders, especially bondholders, and the equity participants. I'm talking about the common stockholders, the owners of the company. Again, this is firm value. Firm value can be thought of as the value generated by the assets of the company, net of current operating liabilities, or in other words, it is the value attributable to both the lenders and owners of the company combined. We all know what firm value is. But what about enterprise value? If we're going to depict enterprise value visually, it would look like this. As you can see, enterprise value is the value of the non-cash working capital plus the long-term assets used in the operations of the business. I'm talking about property, plant, and equipment, as well as intangibles, if any. Meaning, cash is excluded in arriving at the enterprise value. But the question is, Why? Why is this the case? In enterprise valuation, we treat cash as a non-operating asset. Again, we treat cash as a non-operating asset, something that is not used in the primary business of the company. Nowadays, it is possible for businesses to operate with very minimal cash levels. If ever there is a cash requirement in the business relative to the overall assets of that company, it is usually very minimal. Whenever we see a cash balance in this type of balance sheet, we can presume that this cash is sitting idle in the bank, earning a very small interest that is not related to the day-to-day business of the company. Hence, not part of the enterprise value. Thus, if we use the right side of the balance sheet, we're going to offset cash from debt. We call this net debt. So enterprise value can also be arrived at by adding net debt, which is debt minus the cash level plus the equity. We call this the enterprise value. Again, the reason why we exclude cash is because we assume that the cash level that you can see is basically not the one needed in the business. It is simply an amount of funds that is sitting idle in the bank. Having known such, why bother using the enterprise value? Why not just base the company's worth on the firm value? The problem with firm value is that it can be easily manipulated by purely financial transactions. Is it possible to instantly double the worth of the company if we measure the firm value? Actually, the answer is yes, it can easily be doubled. Say, for example, the company issues a large amount of debt. By doing so, that is a debit to cash and credit to debt. So let's issue a large amount of debt. As you can see, you can easily increase the firm value by simply borrowing money. This is not true for enterprise value, as this transaction will have no impact on such kind of valuation. I hope this clears the confusion on the matter. Whether you're an academician or a practitioner, it is important that you know the difference between how value is measured under both methodology. As always, I would appreciate it if you like, share, and subscribe.
Like, share, and subscribe.